You know, the interesting thing is I'm not doing anything differently because I've been preparing for this crisis for a long time. In fact, a lot of people were making fun of me because I've been preparing for so long because they think that what I'm preparing for is never going to happen. Well, it's going to happen. It hasn't really started yet, but we're getting close. You know, the problem is the Fed's been operating its monetary policy while looking in the rearview mirror because they keep creating inflation, right? Printing money, quantitative easing, whatever you want to call it. And they keep printing more and more money. And they look in the rearview mirror and they look at the CPI. And as long as it's below 2% or some version of it is below 2%, they think it's okay to keep printing money. Meanwhile, they're ignoring the road ahead. They keep looking in the rearview mirror at these CPI numbers. And they kept, printing money and inflating asset bubbles and distorting the economy and leading to these debt bubbles and letting the government get bigger and bigger and bigger, spending more and more borrowed money. And then all of a sudden they look in the windshield and they're staring at these big CPI increases. And their initial reaction is, oh, don't worry about it. It's nothing. And then after a few more months, well, it's transitory. It'll go away. And now they've got this huge problem, which has been inevitable for a decade. In fact, back in 2009, when the Fed first made the mistake of going down this road of quantitative easing and 0% interest rates, I predicted exactly the predicament that they're now going into because they have this massive inflation problem. They can't do anything about it. They're talking about tightening up on policy, but what they're talking about doing is going from very loose policy to slightly less loose policy. They're not talking about tight money, which is what they would actually need to put out this inflation fire. But by tightening up a little bit, they're going to prick the bubbles, or they've already pricked the bubble, and you're seeing all these risk assets imploding right now in price. The economy is already rolling over into recession just because the Fed is supplying less monetary heroin than they were. But the fact that they're still supplying some means that the inflation problem is going to keep getting worse. So this is the Fed's worst nightmare. It's stagflation. And the question is, what are they going to do? Are they going to keep tightening up policy and push the economy into another financial crisis, not just a recession? Or are they going to reverse course, go back, reverse any rate hikes, expand quantitative easing, and just make the inflation problem much worse?
Peter, one second. We all know we're screwed. The question is, what if it's going to get worse? What do we do? Kim and I have been preparing for this for years and years and years. Like I said, I invest with you. Kim and I have tons of gold and silver. We do have Bitcoin, which you hate. But anyway, we also have bullets. We're ready for that. Okay? And Peter, we know we have a problem. We've been telling people for years. Kim, any questions for Peter on this?
Yeah, I do. And I just want to, it's a more minor question, and I do want to get to what you're doing and what people need to do. But when you talk about the CPI, the Consumer Price Index, which measures the price of consumer goods, you've said before that they change that number. They change that formula all the time, right? So when they say it's 7%, it's actually a lot more than 7%, isn't it?
Yeah, well, 7% is the number that you get when you use their rigged methodology for calculating consumer prices. And they often compare the inflation today to the 1970s to try to make it appear like it's not that bad. Oh, yeah, it's 7%, but it's nothing like the 1970s. Well, it's actually worse than the 1970s. If you used the same CPI that was used to measure prices in the 1970s, and if you use that identical CPI today, last year was actually worse than any year during the decade of the 1970s. It was about 15%. And the bad news is 2022 is going to be even worse than 2021 because a lot of companies held back on price increases because they thought it was all transitory. Well, now that they realize that's not the case, you have a lot of companies that are rushing to make up for lost ground, and they're announcing major price hikes here in January. They're probably going to do more later in the year. Look at the price of oil. It's already exploding. It's up about 20% in the last few weeks. We're at a new high for the year. We're at $85 a barrel. I think we're headed over 100 this year, maybe closer to 150. I think by next next year will be above 150 in the price of oil. It's not just oil. It's all sorts of energy, but it's agriculture. It's industrial materials. The government is trying to blame it on a supply shortage. It's not a shortage of supply. It's a surplus of money. It's all the money printing that is creating the problem. Had the Fed done the right thing after COVID and contracted money supply, then we wouldn't see these big price increases. Maybe there would have been a reduction in supply, but there would have been an offsetting reduction in demand. Instead, we reduced supply because everybody was staying at home instead of working, but we increased demand because we gave all the people who were staying at home more money to spend than what they used to earn when they actually went to work. So it was the worst of all policy mistakes. We threw gasoline on the inflation fire, and now we're dealing with the consequences, and it's just getting started.
So once again, the question is, what do you do? Because for Kim and I, Kim and I have been saving silver and gold for years and years and years. We use debt to buy income property. So we most of our income coming from real estate. We're not in the stock market, but we're preparing for the future constantly. Peter moved to Puerto Rico. I keep teasing him. I said, if you knew real estate, you would have to be in Puerto Rico. But
well,
anyway.
My best investment last year was my house and my condo here in Puerto Rico. I mean, people don't even believe me when I say this, but real estate has basically gone up 3 to 5x in the last year. I mean, you don't normally see that
Peter, all over the world, Peter. So
but you're talking quadrupling, quintupling in price for a house. So, I mean,
Peter, I understand. Peter, I don't play that stupid game. I mean, I think you know my formula. It's purely one thing: cash flow and don't pay taxes. That's my game. And I don't have to live in Puerto Rico to do that. I give Peter so much grief about this every time I see him.
But that's how you don't pay taxes, is you live here. But as far as
I could live in hell too and not pay taxes. I could live in jail and not pay taxes.
2022, we're off to our best start in years as a asset management company. Most of our stocks are hitting 52-week highs, Peter, even today, with the Dow down 500 points.
The question is, if it's going to get worse. I was listening to Steve Hanke of John Hopkins University. He agrees 100% with you. That is money supply. It's M2. Just pure too much money in the system. But the question is, so what's going to happen? So if let's say they raise interest rates, they push us into a recession. That's going to crush a lot of small businesses, and if prices go up, there'll probably be more unemployment.
Yes, the problem is they're going to raise rates enough to crush the economy, but not enough to slow inflation. And in fact, as inflation gets worse, that's going to be another drag on the economy. And so what you've got to do, what I'm trying to tell you, is you got to get out of all of the bubble assets that were propped up by all the cheap money. Because even though money is cheap, it may be slightly less cheap for a while, and that's enough to collapse the bubble. But you can't just go to cash because inflation is very high and it's eroding away the value of your cash. There's no safety there. You can't buy bonds. Bonds are even worse than cash because it's cash in the future. But in the meanwhile, you're tying your cash up and inflation is eating it up. So people have to go out of these risky momentum stocks into value. And what we're seeing is a massive shift out of U.S. growth stocks to international value stocks in Europe, stocks in Asia, basic businesses that have real earnings right now, that pay good dividends right now. That's where investors are hiding out. That's why you're seeing some of these stocks up 10, 20% on the year with no news, even as U.S. tech stocks are cratering and all the bubble stocks, including the cryptocurrencies. All that stuff is going down. You got to get into real assets. You got to get into value. You got to get out of paper, and you got to get out of U.S. paper in particular, because we've got the biggest inflation problem that we can't do anything about because we're so loaded up with debt. There's no way to fight inflation without collapsing the entire economy, because the whole economy is built on the foundation of these artificially low interest rates. But in order to fight inflation, you have to remove that foundation. And then if you do that, everything built on top of it comes crashing down.